Hey everyone, it's Wednesday, August 31st. The market's moving down and closing toward the lows of the day, just getting below 39.60 to 39.55. Mish Schneider from MarketGauge joining us today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and clear Redmond, Washington. Thanks for joining us every weekday after the close as we learn from the lessons of market history and apply their knowledge of market dynamics to analyze market trends today. We have a lot to talk about. Of course, we're going to dig a little bit into some of the breadth indicators that tell the story of this market environment, accelerating to the upside from mid-June to mid-August, really rolling over from the 200-day moving average. And now a number of breadth indicators starting to tilt neutral, even bearish a little bit. Let's look at the evidence together here with some of the key charts in market breadth and elsewhere. Just to let you know about what's coming on, excited to talk to Mish Schneider here in a few moments. Upcoming guests tomorrow on Thursday the 1st, we have Mike Shell from Shell Capital Management. Next week on Tuesday the 7th, John Kosar from Asbury Research in Chicago. And then on Wednesday, September 8th, joining us for the first time, Hema Reddy, who's an expert in GAN analysis. We're very interested to get her take on what's happening here from a time and cycle perspective. Also wanted to remind you about ChartCon, which is a fantastic event coming up October 7th and 8th. Today's guest, Mish Schneider, will be one of the many fantastic contributors and presenters. We will be flying to our Redmond, Washington office, our brand new studio, to share their expertise. You can sign up for that event at stockcharts.com/ChartCon. I wanted to highlight some of the panels that we're doing. Particularly, we're going to have a panel that focuses on risk management. We're going to talk about how you manage risk in a bull market phase, how you also think about it in a bear market phase, and the importance of focusing on relative strength. These are sessions and some expert observations you cannot afford to miss. Go to stockcharts.com/ChartCon. As a reminder, if you're a member, you get a deeply discounted rate. So it's a really good opportunity, those of you that are not members of StockCharts, to join today. Even take a free trial, and you can access our member pricing for the event. Let's continue on this show with our market recap. Let's break down what's happening in the markets. As I mentioned, the S&P, the major average, is rolling over going into the close. Not a great feeling, because that last 30 minutes is always an interesting illustration or indication of sort of the supply and demand picture. You can see on the two-day preview chart, the S&P closing down around 39.55. That's at the lows for the day. The NASDAQ composite down about the same amount, a little less, around 0.6%. The VIX actually coming off a little bit. And Dave Landry and I talked about this a while ago, about how we often oversimplify and think stronger stocks, weaker VIX, weaker stocks, stronger VIX. There's an inverse relationship. And generally speaking, that's the case. But it's not a guarantee, and the market can go down on lower volatility. It can increase on increasing volatility. It's just a lot less common. So today, the VIX actually came off still very much well above the 20 level, which has ended up being essentially a floor for the VIX for most of the year 2022. Interest rates actually pushing higher going into the close, of the 10-year yield around 3.13, long bond yields around 3.26, and that higher rate environment usually not a good sign for growth stocks, right? And essentially the basic argument there is, as rates go higher, the growthy part, the growth prospects of those growth-oriented stocks like emerging technology, communications names, even some consumer names, are less attractive when rates are going higher, right? The benefit of those growth prospects is minimized or is lessened. As a result, higher rates tend to be not as good for growth stocks, and you see that today with something like technology down and underperforming the market today. Dollar index, not much change here for quite some time. It's chopped around a good bit, but sort of stabilized, if that's one way I would put it. What's interesting is you're actually, while the dollar is sort of stabilizing, you're seeing gold continue to push to the downside. I was scanning for stocks earlier today, stocks making new swing highs and new swing lows. I usually look at 3-month highs and lows. As always, I feel like gold stocks were on there, and it's not just Newmont Mining; it's RGLD and gold and other names in that space, just continuing to show broad weakness. And again, things things having gone down a lot is not my favorite justification for buying something. A long position is deserved when you see signs of improvement or see signs of accumulation. And as far as my approach would dictate. Commodities as a whole down today with the DBC, which is a broad commodity ETF, down about 2%. Looking at cryptocurrencies, mostly in the green, with Bitcoin up about 2%, back above 20,000. We've chopped around that 20,000 level here for a little while. I want to actually start with that chart. We'll get to a chart of the S&P here in a minute, but I just want to touch base on where cryptocurrencies have been. What's interesting is if you look at the chart of Bitcoin now, it's really where it was about 10 weeks ago. You go back to mid-June, we're kind of right about at this point. So all of a sudden, what you can see is this big downtrend move into the lows in mid-June. And this is right where the equity markets bottomed out as well, of course. From there, we've chopped around a bit, but we really haven't gained any ground. We had been, right, in sort of late July, early August, felt like you're getting above 25,000, starting to show some real upside momentum, but we stall out and now pulling back to just above 20,000. 20,000 at the end of the day ends up being the level. And that's what I think this has been. Just like when we hit 30,000, sort of undercut it a little bit and then spent about 6 weeks trying to get through that level before finally going lower. We're now chopping around the 20,000 level. And all of this has been about a bouncing, sort of like the bouncing ball off of that level. If and when that breaks, what's next, right? What's a potential downside target? That's what I would be thinking if you're looking at the chart of Bitcoin. Broke below trendline support. And I've highlighted on the chart, that's not been great for Bitcoin when that's happened previously in 2022, going back to last November, actually. Looking at the S&P 500 here just very briefly to see where we're at. We're finishing again at the lows of the day, below 40,000 now. Yesterday we closed below 4,000. We closed below there had been above there since late July. Now we're back below the 50-day moving average, which is interesting. A lot of individual names also doing that as well. A little later, we'll do a segment called Banking on Breadth, and we'll dig into some of those breadth indicators in a little more detail. What concerns me about the market now is the fact that we're closing at the lows of the day on a day like today. The more that happens, the less optimistic I think you can feel about buyers coming in, because that shows you buyers are not coming in going into the close. It's actually further distribution. And the momentum is starting to get below the normal range you'd expect in a bull market phase, right? One of the things I learned from reading books by Connie Brown, from talking with people like Andrew Cardwell, was that idea of the whole range of an indicator fluctuating based on the regime. And in a bull market phase, the whole range of the RSI tends to be elevated. In a bear market phase, the whole range actually tends to be lessened, right? It tends to decline. And that's what we're seeing. When the RSI doesn't hold 40 on a pullback, that's one of those data points I think that starts to suggest this is more negative than positive. And again, it's an absence of buying power when the price pulls back. The buy on the dips crowd is no longer there. And that should concern, I think, investors about the potential for further downside. So as always, really good time to think about stops and how you're managing risk in this sort of environment. Just to finish off our market recap here very briefly, looking over at the sector side of things, communication services up about 0.25%, and that was it. Everything else was down today. Meta Platforms, the biggest gainer in the S&P 500, up almost 4%. Now, if you look, 4 of the last 5 candles are solid candles, which tells you a little bit about the movement in these markets. I was actually chatting earlier with Steve Bigelow, who's a name that may or may not be familiar with to many of you. He's a longtime technical analyst, really focuses on candlestick analysis. And we were talking about that idea about some of those solid candles, which in general just tells you on a particular day, the close is below the open. But the more you see those proliferating, the more it tells you about the intraday dynamics where there's distribution and not accumulation. So the other 10 S&P sectors down. Materials, the worst performer, down 1.2%. Technology after that, around 1%, followed by consumer discretionary. And again, all of those down about 1% plus. You know, when I think about this market environment and thinking about what's what, 2 observations I will make here just to wrap up our market recap. Number one, sort of a mixed bag with what I call the phenomena stocks, these 8 sort of FANG-like names, and adding things like Microsoft and Meta into the mix. Netflix actually having a positive day as well. Now, neither of those charts look particularly attractive from a trend following perspective. I think both of those still sort of moving lower, but bouncing higher and actually gaining a little bit on a closing basis. To finish off, renewable energy equipment, actually the number one industry group out about 106 that we track. And one that I wanted to highlight was First Solar. When I was scanning for stocks making new swing highs, I love names that when the market is flat to down, that they're actually breaking out. That tells you something's different. It tells you it's not following the broad movement of the market, but it's starting to behave somewhat differently for whatever reason. FSLR, First Solar, making a new 52-week closing high today, making a new 12-month relative high today. That's bullish, certainly, at least for that particular solar name. Let's take a quick commercial break. We'll be back with today's guest, Mish Schneider. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. This toolkit is designed to help you navigate periods just like this. It's designed to help you manage risk and also look for opportunities with a focus on trend and a focus on relative strength. We're going to get to today's guest, Mish Schneider, here in a few moments. But before we bring her on, I want to give you a couple quick announcements. First off, we welcome your questions. Our email is thefinalbar@stockcharts.com. We are also on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment on the video below or the comments below the video you're watching on our StockCharts YouTube channel. We'll hope to answer one of your questions in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. People like Mish Schneider, who have a lot to share and a lot of expertise that they can use to help you understand how to navigate these markets, are available for your picking for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Mish Schneider. Mish is from MarketGauge, joining us from New Mexico. Mish, it's a pleasure to see you. Welcome back to the show.
Thank you, David. It's always a pleasure to see you.
So we have an interesting market environment. When we've talked previously, the first half of 2022, obviously big distribution phase. The last, sort of mid-June to mid-August, a very different look. And now we're pulling back once again. You always do a great job of highlighting with your modern family what's what and where we should be focused. Talk us through these charts. What are you seeing?
Well, the first chart you put up there is the agricultural chart, DBA. And the reason why I wanted to include that is because with all the conversation about inflation, and as you pointed out in the beginning of the show, oil and the metals dropping, and a lot of the industrial metals dropping as well, I thought the food commodities should be a good focus because I think that's going to be a backdrop for a lot of things that could possibly occur. Not only the rising food prices, but also really is a reminder of what's happening weather-wise throughout the world. Pakistan flooded, other places drought, Europe 500 years, worst drought ever, United States problems. And all of this, how it could go forward, not only impacting food prices, hence inflation in that one area, but also geopolitics, because social unrest often follows food shortages. So we need to keep that chart in mind, and that's why that's there. It has been outperforming over the last 2 years, the SPY. It continues to do so. It seems to have a little bit of headwinds because there's an interest rate component in that actual basket. But nonetheless, if the rates actually do anything to fall and the food prices continue, I think this could be fair warning about future inflation and possibly, as I said, geopolitics.
Great area to focus on. Your second chart is the transportation ETF, IYT.
Well, as part of the modern family, transportation, of course, represents really the demand side, and not just consumer demand through UPS and FedEx delivery of goods and travel and airlines, but also industrial manufacturing demand side. So how things are moving on freights, et cetera. And so right now, what's interesting about this chart is that it is outperforming because it is still holding and closed just about right on its 50-day moving average. So it's a very key area to watch. I'm certainly not saying bullish or bearish at this point. I'm saying we will know very, very soon whether we're heading for another leg lower or whether the washout that we've seen since Friday is just that, another washout, and then we'll get another bounce. And of course, we have to remember bounces and trading ranges are going to be very much a theme going forward, but this is a really good key to watch.
That's great. And really approaching key support there with the 50-day moving average. Your next chart is the retail ETF, Granny Retail, if I remember right.
Yes, good old granny. Well, yes, and this is so important. Obviously, the consumer discretionary market, as you mentioned also earlier, was weak today. I think Bed Bath & Beyond had a lot to do with that. But consumer confidence came out great this week, which is interesting. But yet, granny retail is another really important sector, 70% of the gross domestic product, as we know. So if transportation is showing any bright light, granny retail actually broke the 50-day moving average today and is showing the stress of all the conversation about rates and hawkish Fed and, of course, inflation. So again, if you work at the two of them in tandem, you will see if IYT drops down under the 50, then grandma is really relaying to you that we are in for more pain. But if IYT holds and can rally a little bit, I wouldn't be surprised to see grandma follow in kind, because it will just send a message that things aren't as bad as what everybody seems to think.
Ooh, it's a great set of charts to watch. We only have about a minute left, Mish, but I did want to bring up small caps, because traditionally, if you think about risk on when things are okay, I normally think to look at small caps and just see if they're sort of working. What does this tell you about the overall environment here?
Well, you're absolutely right, David. Looking at small caps is key because it is really the crux of the U.S. economy, right? Industrial manufacturing stocks are in there, although I was kind of surprised myself to find out Chewy, which is a pet product, was the number one weighted instrument in the basket. But anyway, this too is hanging on to the 50-day moving average. So it's telling you that the manufacturing of goods and a little bit in the industrial manufacturing side is still holding up. The demand side from the transportation still holding up while consumers fail. If they're going to work as a triage, as I like to say, we have 2 out of 3 showing maybe some signs that we won't crash. But then again, if these both reverse, IYT and IWM under their 50, then like I said, I think, as you mentioned in the earlier show, your risk is going to be really, really important in terms of anything that you have to the long side.
Mish, you always do such a great job of making this seem so easy in terms of how to follow all these inputs. Really appreciate you sharing some expertise with us. Stay safe, be well, and look forward to seeing you really soon for ChartCon up here in Washington.
Can't wait.
All right. Thanks so much, Mish. That's Mish Schneider. Mish is the Director of Education at MarketGauge, coming to us from New Mexico. I'm really excited to have Mish up into our studio here in Redmond, and she's going to be one of the great participants in that event. If you listen to how she described things, I love that observation with small caps, with transports, right? You have a number of things that are right at that key point, right at the 50-day. We talked yesterday about the chart of Disney, right, which is sort of broke out in June, now testing that breakout level from above. That's why it feels like we're sort of right at that point where if we bounce from here, this feels like yet another very tradable bounce. But if things start to fail to hold the levels of support, that could be a concern. And retail breaking the 50-day was one I had not caught until she mentioned it. Great take from Mish Schneider. Let's continue on our show with banking on breadth. Let's talk about some of the breadth indicators that we focus on and think about what they tell us about the broad market environment. We'll start with this chart, which is part of my Mindful Investor live chart list. As a reminder, I have a list of charts that I keep updated on the StockCharts platform. You can all access them. And if you're a member, you can customize them, do all sorts of cool stuff with it. To get to it, by the way, you click on the articles tab, go to my blog, which is called The Mindful Investor, and you'll have a link to a live chart list right at the top of the page. This is one of the charts that's included in that list. And this is really looking at the 4, what I call the major cap tiers, or the 3 major cap tiers, and then the broad market as well. We have the S&P on a closing basis at the top. And then here we have the advanced decline lines, really the cumulative advanced decline lines for the New York Stock Exchange for large caps, mid caps, and small caps. Now, I very subjectively color code these green, orange, and red like a stoplight, and just my general assessment on what they're telling me. And this is, again, not that I would trade anything on this one indicator, but a series of breadth indicators like this one. I sort of look at them all in aggregate and see what the mosaic is, right? What is the picture that I'm seeing painted by the evidence, right? And here you can see that all 4 of these, by the way, while the S&P 500 broke below its June resistance levels around 4170, 4180, broke below there about a week ago, you can see that a number of these also have done so as well, right? And some earlier than others. In the last 24 hours, mid caps and small caps finally got back below those June levels. The level I'm watching on these is the 50-day moving average. Now, not all of these are updated yet for today's close. I would anticipate that maybe 1 or 2 of these actually break below the 50-day in which case I will color code those neutral orange. But again, when you look at price, you're getting a sense of what the market overall is doing as defined by these major indexes. These breadth indicators sort of look underneath the hood and tell you about the stocks that comprise those indexes. They're equal weighted measures of market breadth. So when they are in agreement, that tells you it's not just a small number of stocks causing the move, it's actually broader participation. That's why that's an important chart to watch as this week progresses. Wanted to highlight here, this is a chart we've mentioned a number of times, stocks above their 200-day moving average, stocks above their 50-day moving average. Two observations I would make on this chart. When the S&P hit its 200-day moving average and pulled back, you can see that a lot of stocks had a very similar experience. At that peak, about 2 weeks ago, mid-August, you had 50%, literally almost exactly 50% of the S&P above their 200-day and 50% below. So the S&P rallied to its 200-day, didn't quite get above there. And about half of the market is in a similar configuration. We're not above its 200-day, but that means the other half has currently rallied. Now, the way that they got there is because so many stocks accelerated. This is what's called a breadth thrust, where you have very negative breadth that turns into very positive breadth in a compressed time frame, basically. So we went from about 5% of the S&P above their 50-day up to about 90% in about 8 weeks. From there, we've gone lower. And one of the things that happened today was this indicator got below 50%. It's down to around 43%, which means once again, for the first time since mid-July, less than half of the S&P members are above their 50-day, just like the S&P has now broken below. We talked about how the XRT has broken below. I was talking with Mish about transports and small caps, all testing those. Well, about 35%, that's how the math works, of the S&P 500 members have now broken below their 50-day in the last couple of weeks. That tells you that a lot of names are failing to hold that key level of support. That concerns me about what we might see going next. Now, one of the great tools we have on the StockCharts platform is the point and figure charting engine. I often jot down, need to show more point and figure. It's always hard to think about how to incorporate it into this kind of show. Maybe we'll think about some other ways we can incorporate it into our channel. But some of our contributors, like Bruce Fraser, do a great job of highlighting point and figure charting. We can take our point and figure engine and use it to turn a bunch of individual stocks in a universe into a breadth indicator using their point and figure chart. That's what the bullish percent indexes are designed to do. What percent of the stocks in this universe, in this case, the S&P 500, are in a bullish point and figure pattern at the moment? And currently it's around 55%, just below they're around 54%. Now, a couple of weeks ago, it's just above 80%. I've highlighted here in pink the times when it's been over 70% of the S&P members in a bullish point and figure pattern. You can see what's happened soon after. I've highlighted when they're above 70%. You can see when that stops, when we come back below 70%, those have been some of the more significant turning points, reversions to the downside that we've seen from the markets. That signal was triggered on the 23rd, I want to say, about a week ago. And you can see obviously what's happened since then. We've seen a little further distribution. We also saw that from the NASDAQ 100 bullish percent index. I've highlighted all the times when we went above 70% and then came back down. You can see that it's basically been every major top here in the last certainly in the last 6 to 8 months. So what concerns me about this market environment is, again, we're showing a pattern here recently coming off the 200-day moving average, which is very similar to a lot of the drawdowns that we've seen previously in this year. Now, at some point, that trend changes, and that's what was questionable about this rally in July and August. It lasted longer than any of the other rallies we've seen in 2022, but it appears to be resolving just like all the other ones have been, which is basically to the downside. Now, just to finish off our segment on market breadth, I want to highlight the McClellan oscillator. This is one of our 3-and-3 charts on yesterday's show, and it's a very simple binary signal. Is the McClellan oscillator above or below zero? What this is basically doing, think of it as sort of an RSI for the cumulative advanced decline line, if that makes sense to you. So instead of looking at the cumulative advanced decline line as we show it in our previous chart, this indicator basically takes some different exponential moving averages of the advanced decline series and uses those to sort of calculate an overall trend in the advanced decline line, or basically, to put it another way, the momentum behind the advanced decline line. If it's above zero, the trend is positive. If it's below zero, the trend is negative. And similar, about a week and a half, 2 weeks ago, you saw that indicator go back below zero. And just in general, it means if and when we would see a turn higher in the S&P, you would want to see the McClellan oscillator get back above zero. That would be the confirmation that the uptrend is happening. And if you look, when the indicator is very negative, which is where it is now, that's actually lined up very well with some of the tradable bottoms in 2022, which is why I'm highlighting this chart today. At minus 80 plus, this is pretty much the lowest level we've seen in the last year, and that's usually been fairly viable bounces that we've seen in the index. So does that mean we've come down enough to expect a bottom? For me, it's more about where we're at relative to the zero line, and if we would find a bottom, look to see if that gets back to positive territory. Just want to finish off very quickly looking at new highs and new lows. In terms of other things that concern me about this market, is the fact that we're now seeing an expansion in new lows. As I mentioned before, in a bull market phase, one of the notable characteristics of a bull market phase, you see an expansion in new highs, particularly a healthy bull market phase. So if you look back in 2021, you see a lot of green bars. This is for the New York Stock Exchange, the S&P 500, and the NASDAQ from top to bottom here with these panels below the series on the S&P 500. Green bars basically means you're seeing new 52-week highs in that universe. Red bars mean you're seeing new 52-week lows. A healthy bull market phase shows an expansion in new highs. A bear market phase sees an expansion in new lows. You can see a lot of red in 2022 and very limited amounts where you see green. You saw some at the end of last year, which was going into that peak in January. You saw some in March into April, leading into the late March market peak. And now you saw a little bit there in August, but not a ton, and not nearly as much as you saw back earlier in the year. Now, part of that is obviously we're just so far below the 52-week high for a lot of stocks. But here on the other side is the concern I see. The big downdrafts that we've seen in this market have been marked by an expansion in new lows, and we're just maybe seeing the beginning of that. If you look at the last couple of weeks, you're seeing more and more stocks every day that are making a new 52-week low. That tells you it's weaker rather than stronger. We need to wrap today's show, folks. It goes by so quickly, but it is time for that 3 and 3. Let's hit 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. In our segment, Banking on Breadth, we talked about the percent of stocks above their 200-day and above their 50-day moving average. In the last 24 hours, we've gone back below the 50% level, meaning now less than half of the S&P members are above their 50-day moving average. I think this plays on what my guest today, Mish Schneider, great take on a couple really important charts. Hitting on some of those ETFs that are testing their 50-day, a lot of individual names have failed that test and have already broken down through that 50-day. The bear case for stocks, I think, involves these indicators continuing to go lower, and we're seeing that certainly so far this week. Chart number 2, continuing on this theme of breadth, is looking at the new highs and new lows. I often scan for new 3-month highs and lows for my Market Misbehavior Premium members. I sent a note earlier today highlighting some of those key charts on the move, but thinking about it in terms of a broader breadth story, the fact that you're seeing more red on this chart and not a lot of green tells me a lot about the dynamics of the breadth conditions, and they're negative, not positive, certainly in the last couple of weeks. Finally, this is a chart I very simply call the chart. It highlights 5 different things which I think are important to follow: the closing price of the S&P 500, the advanced decline line for the New York Stock Exchange, the consumer discretionary to staples ratio, the relative strength of utilities flipped upside down, and the relative strength of semiconductors. These last 2 pieces of evidence have really been coming down in the month of August. As we rotate from August into September, be very keen to see if that persists. If utilities are making a new 12-month relative high versus the S&P 500, what does that tell you about how investors are rotating to the defensive side of the coin? Folks, that is our show for today. Special thank you to Mish Schneider from MarketGauge, joining us from New Mexico. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.